Howdy, y'all. Welcome to Liberty Call. Today is Friday, May 19th, 2023. Hope everybody's having a good day out there. It is raining again here in Colorado. So if you're in the spirit for some rain, come up here and visit. We're getting plenty of it the last week or so. So like I said, hope everybody's having a good day. If it's your first time watching Liberty Call, please give me some thumbs up, like, share, subscribes, follows, all that good stuff. I would greatly appreciate it. Not the best day here locally or domestically in the markets. See a little more green around the rest of the world. But let's go ahead and jump in and see how things turned out for today. So, all right, the Dow Jones was down 0.33%, 109 points, closed at 33,426. S&P 500 was down 0.14%, closed at 4191. NASDAQ was down 0.24%, closed at 12,657. The VIX was up 4.74% today. It's currently at 1681. Canada was up 0.27%, Brazil was up 0.58%, and Mexico was down 1.75%. Going over to Europe, Germany was up 0.69%, UK was up 0.19%, France was up 0.61%, Netherlands was up 0.24%. Let's see here, Spain was up 0.42%, Italy up 1.05%, Switzerland up 1.17%, and Portugal down 0.22%. But Russian exchanges were mixed. MOEX was down 0.26%, RTSI was up 0.31%. And the overnights in Asia, Japan, starting out with the Nikkei, was up 0.77%. Australia up 0.59%. New Zealand up 1.52%. In China, the Shanghai was down 0.42%. The Shenzhen Component up 0.12%. China 50 down 0.27%. DJ Shanghai down 0.38%. Hang Seng down 1.4%. And the Taiwan weighted came in up 0.45%. All right, so let's go ahead and take a look and see how we did for the week. All righty. So it looks like, let's see here, the S&P 500, it's going to have a positive week. It looks like it's going to finish off up about 1.57%. The Dow is going to finish the week off up about 0.31%, and NASDAQ finishes off the week up, 3.24%. Pretty good there. And let's see here. The Dow Utilities looks like they're going to be in the red, down almost 5%, 4.93%. And the Dow Transports looks like they're going to finish off in the green, up 0.86%. So looks like everything was in the positive except for the Dow Utilities for the most part, some better than others. But all right, well, that's the week in the markets. Let's go ahead and jump back over to the economic data that came out this week, starting out with jobless claims. Initial jobless claims came in at 242,000. The forecast was 254. Last week's number was 264, so we dropped by about 20,000 there. Continuing claims came in at 1.799 million. Forecast was 1.818 million. Last week's number was 1.807, so down by about 8,000 there. Retail sales year over year grew at 1.6%. The forecast was 4.2. The previous number was 2.42. So we've contracted from the previous number, which was from last month, and well below forecast. So again, kind of everything that we're seeing that the economy is just slowly coming to a halt. Retail sales month over month only grew at 0.4%. The forecast was 0.8%. Industrial production year over year grew at a 0.24%. Last month's number was 0.07%, so a bit of an improvement. But as you can see, over the last 6-9 months, it's been a slow, steady decline. So at least it isn't in the negative like it was back in 2020. But if things continue to deteriorate, I would imagine we'll probably go that direction. Housing starts grew at 1.401 million. The forecast was 1.4 million. The last month's number was 1.371 million. So again, a little bit of a step up from the previous month and in line a little bit less than 2 months ago. So existing home sales, on the other hand, came in at 4.28 million. The forecast was 4.3 million. And we've just been on this steady decline for really since they started raising rates. You've seen the decline in existing home sales. Granted, there's just a lot interest rates have gone up, prices have gone up, and it's pricing a lot of buyers out of the markets. Existing home sales month over month came in at a contraction of negative 3.4%. The forecast was a positive 0.1. Last month's number was a negative 2.6. And the last thing here is the leading index of economic indicators came in at a negative 0.6. Right on forecast. Last month's number was a negative 1.2. All right, so that's all the economic data for the week. Let's go to our market recap. Wall Street slips on debt ceiling uncertainty. Ooh, it sounds scary. All righty. U.S. stocks ended the trading week on a weaker note as early gains evaporated due to a pause in U.S. debt ceiling negotiations, dampening optimism about a potential deal to avoid default. And I saw on the TV earlier that they were halting negotiations for now. So at least the McCarthy's group was going to do that. So we'll see. The market had rallied in the previous two sessions on hopes of an agreement to raise the debt ceiling from $31.4 trillion, with the S&P 500 climbing over 2%. However, reports of a pause in talks and the Federal Reserve Chair Jerome Powell's remarks at a monetary policy panel led to a reversal in early gains on Friday. Investors were disappointed by the halt in negotiations, with Republicans staging a walkout, potentially to increase pressure on the Democratic caucus and take advantage of President Biden's absence overseas. Well, is he really ever there? I mean, if you put like one of those stethoscope up to your ear or up to the top of his head, you'd probably hear or like the gears kind of just grinding. I mean, that'd be my imagination there. The news of the pause in talks on Friday afternoon was viewed as a negative development for the market. Despite the setback on Friday, the S&P 500 and NASDAQ recorded their largest weekly percentage gains since the final week of March. The interest rate outlook remained uncertain, with Powell stating that it is still unclear whether further rate increases are necessary. The central bank is assessing the impact of previous rate hikes, as indicated by recent troubles in the banking sector. Additionally, sentiment was dampened by a CNN report suggesting that U.S. Treasury Secretary Janet Yellen informed bank CEOs that more bank mergers may be necessary following a series of bank failures. Shares of regional banks, which were the first to experience the effects of the Fed's tightening policy, declined, with KBW Regional Banking Index down nearly 3% for the session. However, the index still managed to snap a 3-week streak in declines, finishing the week up nearly 6%. Morgan Stanley shares declined after CEO James Gorman announced his plans to step down from his role within the next 12 months. Foot Locker Inc. experienced a significant drop in its stock price, with the largest daily percentage decline since February 25th of 22, after the footwear retailer lowered its annual sales and profit forecast. The warning also affected the shares of Nike Inc. and Under Armour. This week saw a cautious tone from various retailers, including Target Corp, Home Depot, and TJ Maxx, as consumers adjusted to persistent high inflation and rising interest rates. All right. And then one last article to cover for the week. It's titled, "Is the Worst Behind Us?" This comes from Zero Hedge, was written by Lance Roberts via realinvestmentadvice.com. Let's see what he has to say. The question of whether monetary support could have mitigated the anticipated deep bear market is an intriguing one, particularly considering the aggressive rate hikes by the Federal Reserve. With inverted yield curves, escalating debt levels, and a weak economic data, a recession and bear markets seem inevitable. While the phrase "this time is different" in investing is often met with skepticism, it is worth exploring whether the substantial amount of monetary support and government spending could alter historical outcomes. A thought-provoking question was raised by Michael Arut on Twitter, pondering the likelihood of the fastest tightening cycle coinciding with the highest debt-to-GDP ratio, resulting in a soft landing. Since 1981, the federal government has been on a spending spree, with low interest rates facilitating increasing debt levels. Previous cycles of rate hikes have consistently led to recessions due to the diversion of economic spending towards debt service. The chart provided in the article demonstrates the correlation between rising debt levels and declining economic growth rates. And let's see here. Yeah, you can see that right there. If you want to go to the show notes, you can click the link and see the article yourself. Despite the focus on increased spending to benefit its citizenry, the economic prosperity has increasingly shifted from the middle class to the top 10% of income earners since 1982. The massive fiscal and monetary support in 2020 and 2021 further exacerbates this trend. One factor that mainstream media often overlooks is the significant monetary support provided through the Inflation Reduction Act, amounting to $1.7 trillion in additional direct stimulus payments during the pandemic. This chart highlights that the money supply as a percentage of GDP remains elevated, indicating a prolonged deviation from previous growth trends and requiring time for reversion. And reversion is just when the chart comes back to the mean. Another aspect of monetary support could prevent a more severe recessionary drag is the $1.7 in federal spending approved by the Biden administration in the Inflation Reduction Act. These funds will be allocated to various projects throughout 2023, providing short-term economic support regardless of their ultimate success or failure. While economists and analysts predict a potential slowdown and recession later in the year, the abundance of liquidity currently supporting economic activity suggests that the worst may not be behind us just yet. The stock market's recent rally, particularly led by the NASDAQ, could indicate an improvement in economic data in the coming months. However, recessionary indicators such as inverted yield curves and leading economic index readings raise concern. Although the market and the economy may face challenges in the future, the substantial monetary support in the system could potentially prevent a deep economic downturn. The ongoing debate between these two competing forces will make investing more challenging until the excesses in monetary policy are reversed. I would agree. Kind of just sitting on my hands the last 2 years while the market does stupid stuff and waiting for everything to collapse. And once that happens, we can get back to normal investing where you have your models based upon say 60-40, 50-50, whatever those models are based upon as far as risk tolerances. But right now, I mean, it's just scary to be in equities or fixed income for that matter because of everything that's going on in the world. So, all right, well, that's everything I have for the week. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope you have a wonderful weekend, and I'll talk to you next time. Adios.